So, welcome to the fun zone of property investing, buy to let. You've worked hard, you've saved up, and you know you need to invest in bricks and mortar. Buy to let's where you should start. And today we're going to cover the basics. Buy to let is a proven strategy that quietly pays you month after month. It's been around since the Roman times. It looks simple enough, but you're smart enough to know that there's probably a bit more to it. You want to know what to buy, where to buy, what a good buy-to-let looks like. You want the numbers, the rules, the regulations, even how to scale and buy more than one. Today, I'm going to share the exact playbook that I've used to stack cash flow in houses. I want to show you how to buy them, rent them, watch the values climb, and most important, keep in full control, even when the news and the headlines look scary. We're even going to sketch out some numbers on the whiteboard, and I'm going to show you some real buy-to-lets I've actually bought. Hello, my name's Jess. I'm a landlord. I've done over 1,200 buy-to-let deals in my time. It's my mission to help you start, scale, or optimize a property portfolio. If you find this useful, please share it, like it, subscribe it, hit the notification bell. If you've got questions, drop them in the comments. Grab a pen. Let's go. So let's start with the name. Buy a property and rent it out, buy to let. I'm going to draw my favorite example on the whiteboard. It's the £100,000 house. This isn't a real house. I draw it this way so you can take the maths and translate it to your own area in your real world. Your 100% house is, you can work out the percentages. So you buy a house, you need to make it compliant, get it ready to rent. You're probably not going to be doing a full renovation on your first buy-to-let, but you do need to know how to sort out tied paint, smelly carpets, update the bathroom suite. And if you can buy something a bit cheaper than market value and add a bit of value, even better. So for example, if you can buy this £100,000 house for £95,000, and I'll show you here, look, that's 100, 10 little marks up there, that's 50,000, 90,000's about here. But if you can buy this for £90,000, you've got day one equity of that £10,000. If you buy it for £85,000, this is another way of doing it, but spend £5,000 on fixing the carpets, the paint, doing a bathroom refresh, then you've potentially created some day one equity. That's a really good start. You also need, when you're buying any property to rent out, to tick off the compliance list. So things like gas certificates, EICRs, electric certificates, performance certificates, energy performance certificates, CO alarms. The list goes on. They cost money, but it's not thousands of pounds. Get quotes, work from a checklist, stay organised. Don't be put off. There is a cost to this, there's a little bit of work to do, but it's manageable, and trust me, the payoff is definitely worth it. So, what types of property make a good buy-to-let? And really it comes down to the rent versus the price. The rent you get for the property needs to be enough compared to what you paid for the property, or your mortgage just won't stack up and the deal won't cash flow. So usually you're looking at a 2 or 3 bed house, towards the lower end of the market probably. Look at your local area and compare purchase prices and rents. If a cheaper house rents for, let's say, £1,000 a month, but a house that's 5 times the price only rents for £2,000, you can see how the cheaper house gives you a better return. And that's what we mean by a naturally good yield. The banks care about that too. So understanding yield and loan cover is really important. Let's head back to the whiteboard. We're looking at our £100,000 example again. If this £100,000 example house rents for £500, so we're starting to talk about what the house is worth, £100,000. Remember, it's not a real world example. I'm doing it to work out the percentages for you. If you are buying a £200,000 house or a £50,000 house, you can translate it. If this house rents out for £500 a month, and I can write that there, 500 PCM, that equals £6,000 per annum. Okay, that's easy. Now, to work out the yield, you need to take the £6,000, the annual rent, divide it by £100,000, the property value, and times it by 100. I think that's pretty easy maths, even I can do that one. It's a 6% yield. Now, interestingly, if you'd have bought the same house for £80,000, that would be a 7.5% yield. And that's the power of buying below market value. So 7.5% if 75. Okay. So yeah, it's worth pointing out that is probably not buy-to-let basics, but it's important to start to think about that, particularly if you want to scale and buy more than one. Now let's say we want to borrow 75% of the £100,000 value. So 75% loan. The bank, before they lend you that money, they will run what's called a stress test. Now they're going to assume that you're paying 5% interest, even if you're not. So 5% of £75,000 is £3,750 a year. So get a calculator, press pause, do the working it out. 3,750 per annum if you borrow £75,000 and you paid 5%. And this is a stress test. You might look on the mortgage rates now and be getting 3%, but the banks are stress testing it. Now the banks want to see, usually they've all got their own slightly different rules, but they want to see at least 125% cover. So they're going to work out that the £312 a month that costs, so 3,750 per annum is 312 per calendar month. I know my maths isn't that good, I've got it written down there. If they test that at 125%, that becomes £390 per calendar month. So you're going to need to rent that property for at least £390 to pass their rental stress test. And luckily you do, it's there, £500 a month. Now here's why this matters. If you're using a mortgage, the banks are going to stress test to this rule. But here's a top tip, and here's why it matters. Even if you're not using a mortgage, this stress test is a great check. The banks know a thing or two about risk. If a bank wouldn't lend on it, you probably shouldn't buy it. So a great test. Banks need it, great test for you. By the way, we are talking interest-only figures here. No amortization, no paying down the debt. Most investors use interest-only mortgages. Choosing which is best for you is a different subject for a different day. So it's good to know that if you use a mortgage, lenders won't let you buy a deal that isn't fit and ready to rent. It doesn't look like it's going to make money every month. It's a bad property, the wrong house. The flip side of buying the wrong house is, of course, buying the right house. Most houses go up in value over the long term. I've bought 1,200 buy-to-lets. Some have done better than others, but none of them have gone backwards. Even ones I thought were a bit duff came good in the end. But if you can find a bargain property in an up-and-coming area, you can supercharge your growth. On average, houses double in value about every 10 years, depending on what metric you read on average. I've bought some houses that have doubled in value in 3 or 5 years. So if you want to scale a portfolio, it's definitely worth digging into how to find those houses and how to find those areas. But again, another time, this is buy-to-let basics. Buying the right property in the right area at the right price, ensuring it's ready to rent out is important. You've got to do that. More on that, on mortgages, getting the right tenant and putting it all together in a moment. But what I think will be useful for now is to flash up a graphic showing some of the 1,200 houses I bought. A picture speaks 1,000 words. You've seen Victorian terraces, 1950s council style houses, 90s vanilla boxes, ex-authority stuff. There's a few detached houses in there, semis. There's no mega mansions, just homes in areas with naturally good views. That's the key. Buying the right area, the right price, make sure the rents stack up. So, for now, you've bought a house, well done. As the name suggests, buy to let. you rent it out. Once it's let, you are a landlord. So as long as you bought the right house in the right area, where there's good rental demand, you shouldn't have a problem finding a tenant. There's a shortage of decent safe homes in to rent, there just is. So, however, you do need to know that when you rent out a property, you become a landlord and you take on some obligations. You definitely need to keep that in mind. You need to keep the property in a decent and safe condition, annual checks, certificates, doing regular maintenance. When you rent out a property, there are rules you need to follow to stay on the right side of tenancy law. You might need a license, you might need special insurance, well, you will need special insurance. You'll definitely need the right tenancy paperwork, an assured short-hold tenancy, deposit protection certificates, deregulation paperwork, how to rent guides. They all need to be signed and served in the right way at the right time. Otherwise, you're going to be storing up trouble down the line. Again, don't get overwhelmed. Be organised, have a checklist of what's necessary. Have a look around here. You'll find plenty of advice from me on this site. It's definitely worth flagging up right now though that you're going to need to devote some time to this endeavour, and it's not without a certain amount of hassle. You know, a 2 o'clock in the morning, Sunday morning phone call about a water leak will definitely be hassle. Don't be disheartened. It shouldn't be you taking that Sunday phone call. There are systems you can put in place to ensure it's not. So the hassle of that Sunday morning phone call is optional, but one thing I know is not optional, and I believe that you need to be engaged with the idea of being a landlord. Look, it's very sensible to think of yourself as being an investor, to be a little bit dispassionate about the property, to focus on the numbers. It's sensible to treat your buy-to-let as a business, but never forget you are a landlord and you have these obligations. And I think it's important that you get into being a landlord with your eyes wide open, being engaged about your business, about your industry. It helps prevent the classic hands-on, overworked landlord with an underperforming portfolio, or the passive landlord that got the same thing. We've all seen those landlords stressed out with tenant maintenance, or confused and angry about a property they've never seen in years and know nothing about. To both those types of landlords, their property feels more like a millstone around their neck than something that puts food on the table, an asset that puts food on the table. With the right plan, upfront and ongoing, all of that's avoidable. My best advice is to find something. If you're not something in full-time property, find a good letting agent to work with. A little plug for the landlords.com letting agent I own. We'd love to do that. We might be in your area, check, or find a good local one to you. So that's it. You buy a property to let. The tenant pays you every month. If you bought the right house in the right area, ideally it goes up in value. You should be holding long term. Buying the right house in the right area, ensure you're generating income and capital growth. If you get everything in your property journey, it just becomes easy and you can scale. If you get it wrong, it's totally true. Everything becomes riskier, slower, more expensive, and you stall. So just resolve to do it right. My personal view is property done right is the best wealth creation method on planet Earth. I'm biased. I own property related business, you can see that. But first and foremost, I'm a landlord. I eat my own cookies. Property gives me an amazing lifestyle. I've been a landlord for over 20 years now. I'm still growing, and seek out more of our content and perhaps you'll find the proof points you're looking for. The fact I'm still going at it, that probably tells you something. I feel like if you stop there, we'd be missing what's arguably property's superpower. How did I manage to buy so many buy-to-let properties? I didn't start out with millions of pounds. If you want to scale a property portfolio, knowing this is key. It's not buy-to-let basics, one step on. Now I know mortgages aren't for everyone. Some people are scared of debt, but the reason that buy-to-let can work so well is leverage. You don't need to buy the whole house in cash. And if you have never considered mortgages or mortgages scare you, sit down, think carefully about the steps you're going to make, ask sensible questions, and have well managed, easily serviceable, safe debt on an asset that pays you every month. It's a smart move, and I'll tell you why. Just imagine you've got £25,000 and you buy stocks and shares, on the stock market, and the stocks and shares market moves 10%, you make £2,500, easy maths. Put the same 25% into my property here, so this is the deposit, 25, okay. If the property market moves at the same rate as the example stock market, you make your gain on the whole £100,000, you make £10,000. 2.5 versus £10,000. Plus, you're getting your mortgage paid by the rent. You can't get a mortgage to buy stocks and shares, and it has to be a pretty strong dividend in any case to cover the loan. You can see why it's a superpower. Putting it all together, you buy the right house, something smallish, where the price you pay versus the rent you'll bring in offers a good yield, a natural yield. Try and buy a bargain where you can, create that day one equity. If you can identify an area that's got good potential for a higher than average capital growth over the next 5 years or so, even better. If you can get a mortgage, there's that test to ensure that the property is in lettable condition and it needs to rent for enough that the mortgage will cover the loan, the rent will cover the loan. You need to ensure it's compliant, get all the certificates and licenses, and you need to maintain it that way for tenants. You'll probably want to retain the services of a good letting agent to cover off compliance, paperwork. Make sure you aren't receiving those 2 AM phone calls. If you're new to investing, buy to let is where you start, hands down. No heavy refurbs, no buy, rent, refurbish, refinance, no HMOs, no service accommodation, just a solid, smart, safe buy to let that you'd happily hold forever. Get the right managing agent, you can put them in a portfolio, you can forget about them. I hope you found that useful. If you did, can you please share, like, subscribe, join. It really helps our reach and it enables us to keep spending the time and the money making the content like we do. And you join a tribe of landlords looking to start, scale, optimize a portfolio whilst enjoying the journey. So, any questions? Just comment, drop them in there. I'll do my best to answer as many as I can. I'll see you next time. Bye for now.